Welcome to What the Tech, where we cut through the hype to get to the real story. So, you've probably heard the headlines, right? The US economy is resilient. It's surprisingly strong. Well, we're here to tell you that's not the whole story. In fact, it's not even the right story. The economy isn't resilient, it's fragile, and we're going to show you exactly why. All right, let's dive right in. The best way to picture what's happening is with this quote from economist Peter Atwater. He says, "The economy is like a top-heavy Jenga tower." And honestly, that's the perfect metaphor. You know how it is. From across the room, the tower looks fine, maybe even strong. But when you get right up close, you can see it wobbling. You can see the cracks. And that's what we're going to do today. We're going to get up close and show you which blocks are loose and ready to fall. Okay, so first things first, the top-heavy economy. This is the story you're seeing on the surface, the one everyone's talking about. You know, that narrative of this amazingly resilient economy that just keeps chugging along. But, and this is a huge but, what they're calling resilience is really just a massive, and I mean massive, concentration of risk. Let's unpack that. Just look at these numbers. This is, well, it's wild. 63%. Almost two-thirds of all consumer spending in the entire country is coming from just the top 20% of earners. Think about that for a second. This isn't some healthy, widespread recovery. No way. This is an economy that's basically being held up by the spending habits of a very, very small group of wealthy households. That's our Jenga tower right there, incredibly top-heavy. So while the top is out there spending, what's everyone else doing? They're pulling back. And this is the really critical part, so pay attention. Normally, you'd see this happen after a wave of layoffs, right? A typical recession. But that's not what's happening now. People are retreating because they're getting hammered by price shocks and all the noise and uncertainty from policy changes. This isn't just a temporary blip on the radar. This is a deep behavioral shift. It's a scar. Right. So that's the surface story. But now we're going to talk about what the news misses. Because the real story, it's not on the surface. Look, the mainstream media, they see this split happening. They're not blind. But they completely, totally miss the why. They miss the most dangerous piece of the puzzle, the actual reason our Jenga tower is so wobbly. And hey, we're about to dive deep into those root causes, the stuff the headlines always ignore. If this is the kind of hard-hitting analysis you want, do us a quick favor and hit that like button and subscribe to the What the Tech channel. It's the best way to make sure you don't miss these kinds of breakdowns. Okay, so the news gets the first part right. Demand is super concentrated. But here's what they miss. This didn't just happen by itself. It's not a random act of nature. It is the direct result of specific policy choices. We're talking about all the erratic interest rate hikes, the massive stimulus packages, the talk of tariffs, all of it. It's created this policy whiplash that's constantly pushing and pulling on that Jenga tower, making it less stable by the day. Here's another one. The headlines say corporate earnings look okay. And sure, if you just glance at the top-line numbers, maybe. But the real story is in the mix. It's become incredibly fragile. All those luxury brands, the high-end travel companies, they go on their earnings calls and tell Wall Street, oh, things are just slowing a bit. It's not weak. You know what that is? That's code. The truth is they are complete and total hostages to the stock market. Let the S&P 500 take a 15% haircut and watch their entire business model just, poof, evaporate overnight. And my personal favorite, consumer sentiment is down. Seriously? Sentiment is such a polite, useless word for what's actually happening. Let's be real. If you're someone who doesn't own a bunch of stocks or a portfolio of real estate, basically if you're a price taker, not a price maker, then you have been slapped with what is, for all intents and purposes, a permanent 27% tax on your cost of living since 2020. This has nothing to do with feelings. It's just brutal math. And that math is absolutely crushing the bottom 80%. Okay, so let's get to it. The real fault lines. These are the deep, structural cracks that the C-suite is either pretending not to see or is just way too scared to mention on an earnings call. This number, 27%, this is everything. Forget about the monthly inflation reports you see on the news. That's just political theater, watching the rate of change. The only number that actually matters to real people is this one. It represents the permanent, baked-in jump in the price of everything since 2020. You don't spend percentages at the grocery store. You spend dollars. And this damage, it's done. It's permanent.
So all this stuff boils down to four huge hidden risks. First, you've got this wealth effect overhang. That's just a fancy way of saying high-end spending. It's completely dependent on the stock market staying high. Then there's the policy whiplash we talked about, just constant uncertainty. Third, creeping credit quality issues. People are falling behind on their bills. And finally, this really interesting one, corporate price anchoring. This is where companies have basically painted themselves into a corner.
So let's talk about this price anchoring, because it's a huge deal. Think about it. Every company jacked up their prices over the last few years, and now they're stuck. They are absolutely terrified to lower them because it would crush their profit margins and basically signal that their premium product isn't worth the premium anymore. So what do they do instead? Well, you've seen it. They shrink the box, they run a special promotion every other week. It's a total time bomb for their margins, just waiting to explode. So the big question is, where does this go from here? We need to talk about the 3 paths to a break. Forget all that talk about a soft landing. That's not the game we're playing. There are 3 very real ways this Jenga tower could come crashing down.
All right, so path number 1 is what we call the slow bleed. This is where stocks kind of hang in there, but unemployment slowly ticks up, and the financial pain for the bottom 80% just grinds on, day after day. Path 2 is the one to really worry about, the fragility snap. That's a sharp 15–20% drop in the stock market that triggers layoffs in high-income jobs, and suddenly that top-tier spending just stops, cold. And then there's path 3, the policy choke. This is where some boneheaded decision, like a new round of tariffs, sparks another round of inflation and necessities and just strangles what's left of consumer spending.
Okay, so enough with the doom and gloom scenarios. Let's get tactical. Who's exposed and what to watch? This is the strategic playbook. Who's most at risk right now? And more importantly, what are the specific signals you should be watching? The ones the news won't even mention until it's way too late. The exposure map is pretty straightforward. The companies with the highest exposure are the ones that are totally dependent on that top 20%. We're talking high-end hospitality, fancy restaurants, aspirational retail, all the stuff that relies on the wealth effect. And who's insulated? Well, think about it. The discounters, the grocery stores, they're actually set to benefit when everyone else is forced to tighten their belts and trade down. Okay, so that leads to the million-dollar question, right? How can you actually see the break coming before it hits the headlines? The key is to stop paying attention to those stale monthly government reports and start looking at the real-time weekly signals. And this right here, this is your WtT weekly dashboard. These are the signals that actually matter. First, look at high-frequency credit card data that tracks affluent spending. Is it slowing down? Second, watch promo intensity. How deep are the discounts getting? Are store brands taking over the shelves? Third, delinquency rates. Are more people falling behind on their car loans and credit cards? And finally, job postings in those high-income sectors, tech, finance. These are your canaries in the coal mine. They'll warn you weeks before the official numbers even have a clue what's going on. So we'll leave you with this final thought. An economy built on a foundation of soaring asset prices isn't resilient. It's just concentrated. And the real risk here isn't some slow, gentle slowdown. It's a snap. Because if the top of this Jenga tower starts to really wobble, believe me, you are not going to have time to rearrange the blocks. Thanks for watching WtT.